Cintas just delivered a definitive beat for the fourth quarter of fiscal 2026, completely blowing past consensus on both the top and bottom lines.
Right.
Let's look directly at the numbers.
Yeah, let's get into it.
So revenue came in at a record $2.91 billion for the quarter. That is an 8.9% increase year over year.
Right. And if you strip out acquisitions and, foreign currency fluctuations, their organic revenue growth rate still hit 8.4%.
Which is massive.
Right.
And adjusted diluted EPS came in at 1.29, which is an 18.3% increase over last year.
Yeah, a really strong beat.
Looking ahead, management set their fiscal 2027 revenue guidance to a range of $12.10 billion to $12.25 billion.
With adjusted EPS expected somewhere between 5.36 and 5.50.
Exactly. But since they didn't explicitly detail the post-market stock reaction in the primary release, we have to look at the broader proxy for market satisfaction, right?
Well, yeah, and that's heavily tied to how management handles the cash generated by those record numbers.
Right, the capital return.
Exactly. In fiscal 2026, Cintas returned a staggering $1.65 billion in capital to shareholders.
Wow.
Yeah. Pulling from their cash flow statement, that breaks down to just over $952 million in share buybacks and about $701 million in dividends paid out.
That is aggressive.
Totally. Returning capital that aggressively, especially in the current macro environment, it signals extreme confidence from the board regarding their balance sheet.
I have to pause on that EPS beat, though.
Oh, the adjusted number?
Yeah, the 1.29 is an adjusted number. If you dig into the reconciliation tables, management specifically excluded a 3-cent impact from transaction expenses in the fourth quarter.
Right.
I mean, 3 cents on a per-share basis seems negligible, but it highlights massive corporate maneuvers happening behind the scenes.
It absolutely does.
This isn't just a straightforward operational quarter. They are spending millions of dollars on activities way outside of their core business of, washing uniforms and restocking first aid cabinets.
Which means you really have to separate the underlying operational machinery from those corporate maneuvers to understand the actual health of the business.
Right. So let's look at the operations first.
The core story of this quarter is a masterclass in margin expansion. I mean, total gross margin hit an all-time high of 51.0%.
That's up from, 49.7% last year?
Exactly. That is an increase of 130 basis points.
Which is crazy for this industry.
It really is. In a business predicated on physical logistics, operating fleets of trucks, purchasing raw materials, squeezing an extra penny and a third of profit out of every single dollar of revenue is an incredibly difficult structural achievement.
So I look at the segment breakdown to figure out how they actually squeezed out that 130 basis points. And the core uniform business wasn't actually the star player here.
No, it wasn't.
You split the revenue into the two main reporting buckets. The core segment, Uniform Rental and Facility Services, brought in the lion's share at $2.19 billion.
And the gross margin there expanded to a very respectable 50.2%.
Right. But the profitability in their other category is doing the heavy lifting.
Oh yeah, the first aid and safety services.
Exactly. That category generated $368.1 million on its own, along with their fire protection and uniform direct sale businesses. The gross margin in that other category hit 53.4%.
Which is wild.
It is. They're making better margins on first aid cabinets and fire extinguishers than they are on the core uniform rentals.
Well, it makes complete sense when you examine the unit economics of those two different business lines.
How so?
Think about the physical reality of the uniform rental business. It requires massive, capital-intensive industrial laundry facilities.
Right, the washing equipment.
Exactly. You have heavy depreciation on that equipment, constant consumption of water, and specialized chemicals.
And the garments themselves degrade. Right, they need to be repaired or replaced.
Precisely. Now compare that to restocking a first aid cabinet. You are sending the exact same driver in the exact same truck to a facility they are already visiting to drop off uniforms.
Oh, I see. So the marginal cost of delivering that extra box of bandages is essentially zero.
Exactly. But the product inside that box, the sterile supplies, the safety glasses, the PPE, has a tremendous markup.
Wow. Yeah.
There's no washing, no heavy depreciation. It's just a low-touch, recurring refill model.
So the combination of those two dynamics pushes the aggregate gross margin to that record 51.0%.
Right. And it translates directly down the income statement.
Yeah. Operating income for the fourth quarter increased by 12.7% to $673 million.
Which means operating income grew significantly faster than the 8.9% revenue growth.
That is textbook operating leverage at play.
Yeah, to visualize that operating leverage, think of it like running a commercial gym.
Okay.
The gym has fixed costs, right? The lease on the building, the electricity, the cost of the treadmills.
Yeah.
Once the gym signs up enough members to cover those fixed costs, the fee from every single new member who walks through the door is almost pure profit.
Oh, that makes sense.
Cintas is experiencing a similar dynamic. As their revenues scale across their established geographic routes, their fixed infrastructure costs are staying relatively flat.
So more of every new dollar collected is flowing straight to the bottom line.
Exactly, bumping operating income as a percent of revenue up to 23.2%.
So CEO Todd Schneider attributed this performance to the clear impact of investments in technology, capacity, and talent.
Yeah, he highlighted their ability to deliver these results in a, quote, dynamic macro environment.
Which usually just means inflation and economic uncertainty.
Pretty much, yeah.
But looking at the data, the cost of uniform rental and facility services only rose 5.7% in the quarter, while the revenue for that segment rose 8.2%.
The technology investments are demonstrably suppressing their cost inflation.
Like what kind of technology?
Well, deploying dynamic routing technology for their delivery fleets or implementing RFID tracking and automation inside those industrial laundry facilities, it directly reduces their cost of goods sold.
Oh, right, because of the chips in the uniforms?
Exactly. When every uniform has an RFID chip, you eliminate manual sorting. When software optimizes a delivery route in real time to avoid traffic and minimize left turns, you reduce fuel consumption.
And you probably allow a single driver to hit more customer facilities in an 8-hour shift.
Right. Those micro efficiencies aggregate across tens of thousands of daily routes to produce that 51% margin.
I am extremely skeptical about how long this can last, though.
Why is that?
Well, if they are already at an all-time high gross margin of 51%, we have to ask if we are looking at a plateau.
That's a fair point.
I mean, how much more juice can they really squeeze out of their operations? You can only optimize a delivery route so many times before physics gets in the way.
Yeah, you can't eliminate distance.
Right. And you can only automate a laundry facility so much before you hit the absolute physical limits of the business model.
Squeezing blood from a stone has a terminal endpoint.
Exactly. Especially when management keeps reminding everyone about this dynamic macro environment.
Well, that terminal endpoint on organic margin expansion is exactly what forces a shift in strategy.
You mean M&A?
Yeah.
Right.
When you cap out on internal efficiency, you have to buy your growth to satisfy the market.
Which brings us back to their balance sheet.
Right. Cintas is a cash-generating machine. For the full fiscal year 2026, they generated $2.28 billion in cash flow from operating activities.
That's huge. And they spent, what, $395.1 million on capital expenditures?
Yep, which is about 3.5% of revenue. That leaves them with $1.88 billion in free cash flow.
That massive pile of dry powder is what enables the corporate maneuvers driving that 3-cent adjusted EPS exclusion we talked about.
Precisely.
The UniFirst acquisition is the elephant in the room here. This is the structural shift I was talking about.
It's massive. On June 11, 2026, UniFirst shareholders voted to approve the acquisition by Cintas.
This represents a massive consolidation play in the uniform and facility services space. But a major regulatory hurdle just appeared out of nowhere.
Well, maybe not out of nowhere, but yeah. Both Cintas and UniFirst received a second request for additional information from the U.S. Federal Trade Commission regarding the merger.
What does a second request actually mean, practically?
It's a very significant development in an antitrust review. Under the Hart-Scott-Rodino Act, companies have to notify the government of large mergers, and the FTC usually has 30 days to review.
Okay.
Issuing a second request stops that clock entirely.
Oh, wow.
Yeah. It means the government is demanding terabytes of internal data, emails, and pricing models to determine if combining these two giants will create local monopolies.
Because the uniform rental business is highly regional. Right.
Exactly. The FTC isn't just looking at national market share. They are looking at specific cities and industrial parts to see if a combined Cintas and UniFirst would reduce competition to the point of harming consumers.
And driving up prices.
Right.
Well, management claims this second request was expected, and Schneider stated they still project the acquisition to close in the second half of calendar 2026.
Expected or not, the financial impact is already hitting the books.
Yeah, in the fourth quarter alone, Cintas took a $14 million hit in transaction expenses related to UniFirst.
And for the full fiscal year, it was $15.1 million. That is an army of antitrust lawyers and investment bankers billing by the hour while the FTC digs through their hard drives.
But the financial drag goes beyond just the legal fees, doesn't it?
Oh, absolutely. The fiscal 2027 guidance completely excludes any expected impacts from the proposed UniFirst acquisition.
Why?
Because management simply cannot reasonably estimate them at this time. They haven't even reconciled their adjusted EPS guidance to standard accounting measures because of the wild variability of these pending transaction costs.
It is kind of like buying a new house.
How do you mean?
Well, you sign the papers, you lock in the price with the seller on June 11th, but the inspector, the FTC, demands a massive invasive look at the foundation.
Well, I like that analogy.
Yeah, you still plan to move in, but until that inspector actually hands over the keys, you cannot accurately budget your new mortgage, your renovation costs, or your timeline.
Right.
And while you wait, you are still paying holding costs.
And those holding costs are the most immediate threat to their forward earnings.
Because of the debt.
Exactly. Looking at the balance sheet projections, fiscal 2027 interest expense, net of interest income, is expected to be approximately $105 million.
That is a material increase from the $101.2 million in fiscal 2026.
And the earnings release explicitly states this increase is primarily a result of the amortization of bridge loan financing expenses related to the UniFirst acquisition.
Let's break down that bridge loan mechanic for a second.
Sure.
To make a multi-billion-dollar offer for UniFirst, Cintas had to secure guaranteed financing from banks.
Right.
The banks commit that capital, but they charge a hefty fee just to hold it ready.
Yeah, Cintas is essentially paying rent on a massive pile of money they aren't allowed to use yet.
Which is crazy. That carrying cost is actively dragging down their projected net income for fiscal 2027, proving why this record operational quarter is actually sitting on a very fragile foundation for next year.
The fragility of that foundation is fully exposed in the caveats baked into management's projections for fiscal 2027, too.
Yeah, talk about a vacuum.
Seriously. The guidance assumes a constant foreign currency exchange rate. It assumes absolutely zero future share buybacks.
Which is a massive variable, considering they just deployed nearly $1 billion into buybacks.
Exactly. And most importantly, the guidance assumes no significant economic disruptions or downturns.
It gets even more nuanced when you look at the calendar quirk, too.
Oh, the extra workday.
Right? Fiscal year 2027 has 261 workdays compared to 260 in fiscal 2026.
Yeah.
In a business model built entirely on daily deliveries and facility servicing, one extra workday is essentially a free bump to the top line.
It really is. If you do the math on their workday adjusted revenue growth table, the top end guidance of 8.7% total revenue growth actually scales down to 8.3%.
When you strip out that extra day.
Right, and that single day matters immensely because of the route density we discussed earlier.
Oh, because the fixed costs are already covered.
Exactly. When a driver runs a route on that 261st day, the fixed costs of the truck and the facility are already amortized across the year. The revenue generated on that final extra day drops almost entirely to the bottom line.
It artificially inflates the year-over-year growth metrics unless you specifically adjust for it.
Yeah, it does.
So, assuming constant currency, assuming zero economic downturns, explicitly ignoring future share buybacks, and totally walling off the massive pending acquisition, it makes this guidance look like a best-case scenario vacuum.
It's very optimistic.
They are projecting strength, but they are leaving themselves incredibly vulnerable if inflation spikes again, if fuel costs surge, or if the broader economy simply slows down.
This is why the caution concerning forward-looking statements section of their release is critical reading.
It really is.
It operates as a literal map of their vulnerabilities. Cintas relies on a massive physical delivery fleet and an enormous labor pool.
And the risks they explicitly call out include greater than anticipated operating costs, specifically energy and fuel costs.
Right. If the price of crude oil spikes globally, the cost to run thousands of delivery trucks across North America surges instantly.
And they cannot pass those costs onto their customers fast enough to protect their margins.
Exactly. They also explicitly call out the possibility of increased medical costs and the costs and possible effects of union organizing activities.
When you employ tens of thousands of people across industrial laundries, warehouses, and delivery routes, labor relations and healthcare inflation are not abstract concepts.
No, not at all. They are massive line items that can eat into that pristine 51% gross margin overnight.
On the revenue side, they also flag the potential loss of customers due to outsourcing trends, alongside general supply chain constraints.
But the most significant macroeconomic risk is their leverage to the headcount of their customer base.
This is such a fascinating point.
Yeah, think of Cintas as a toll road on the U.S. labor market.
That toll road analogy perfectly illustrates the risk. Cintas doesn't just need their customer businesses to exist. They need the physical headcount at those businesses to remain high.
Exactly.
If a manufacturing plant facing a mild recession drops from 500 workers to 400 workers, that is, 100 fewer uniforms washed per week, 100 fewer lockers rented, and fewer safety supplies consumed.
But the Cintas delivery truck still has to drive the exact same distance to reach that plant.
Right. The revenue drops instantly, but the fixed delivery cost remains exactly the same.
The operational health of Cintas is inextricably linked to the physical utilization of commercial and industrial space.
Yeah, if offices are half empty due to hybrid work, fewer floor mats need to be cleaned, and fewer restroom dispensers need to be refilled.
The fact that they are posting 8.4% organic growth despite these macro pressures indicates they are currently capturing market share from smaller regional players.
And aggressively cross-selling highly profitable services, like those first aid cabinets, to their existing customer base.
Synthesizing these micro details back into the macro perspective gives us a very clear picture of where Cintas stands today.
Operationally, they are operating at absolute peak efficiency.
Yeah, they have engineered record gross margins, their operating income is scaling significantly faster than their revenue, and they are generating well over $2 billion in operating cash flow.
They have squeezed every possible drop of efficiency out of their current footprint.
Which means the entire narrative for fiscal 2027 hinges on execution in the face of severe regulatory and integration uncertainty.
Can they successfully satisfy the FTC's second request without being forced to divest highly profitable regional routes?
And if they do manage to close the UniFirst deal in the second half of the year, can they integrate a massive, potentially less efficient competitor without completely breaking their current, finely tuned margin engine?
That is the multi-billion-dollar question that will define their stock performance over the next 12 months. But stepping back from the specific ticker, this earnings report leaves you with a broader economic thought to consider.
Oh, definitely.
Cintas' entire brand identity revolves around getting companies ready for the workday. They provide the literal uniforms, the safety equipment, and the facility supplies that allow the physical economy to function on a daily basis.
Right.
If a bellwether company tied so intimately to physical employment levels and facility operations is posting 8.4% organic growth and confidently guiding even higher for next year, what does that tell you about the underlying hidden resilience of the broader U.S. labor market? Follow the show for our daily earnings coverage.